Okay. Is this working now? Okay. So this is my second live show. So I'm just gonna test it out. Just give me 1 second. Okay, I'm just gonna maybe wait a couple of minutes or just until someone perhaps gets on just to make sure that they could hear me. Okay, great. Great, okay. So I think people could hear me, so I will begin. So this is my second live show, so I just thank you so much to those who were able to join. Last week was my first one. I had a really good time. I don't mind doing this on a weekly basis just to kind of go over some of the stocks I'm looking at. And today I'm going to be going through a update on Nano-X imaging. I talked about that last week, but there were a couple of short reports that were previously that I discussed about, and then I saw a no report to kind of analyze those two short reports that I talked about last week. As well as I'm going to be giving an update on FEAC, FEAC, SEC Limited, and Crowdstrike. Those three companies I've talked about in my past videos, so if you haven't had a chance yet, just please watch those videos on your next time when you have a chance. And then I will also do a deep dive on NGA stock, which is merging with Lion Electric. So those are the few things I'll be doing today. Okay, so just do this. Okay, great. Okay, so the first one I want to talk about is, let's talk about FEAC. So this one had a huge run up today. It looks like even after hours. Probably anticipation of the merger coming up. It's expected to be voted on December the 16th. It's really interesting. I talked about this one probably 2 videos ago, probably a few months ago when when the merger announcement was just announced. It was trading probably in the $12 range perhaps, or maybe 14, and then it came back down. Now it's about $19. So I really like this company because so for those that don't know, they're games, pretty much iGaming, so they're kind of competing against each other to win these prizes. I really like their business model. I have their investor slide deck up. And I talked about this in my last video, but just a few things I want to highlight that I really like and why I really like the company. Just go to the slide. So this is one of the slides that really interests me. So the total minutes per user per day for Skills is 62 minutes, which is incredible. And then that's higher than TikTok, Facebook, YouTube, Candy Crush, etc. So to me, I think that's really impressive. I think a lot of companies are competing against each other for time on their app or spending time on whatever they're doing, and knowing that Skills were able to attract users this amount of time is really encouraging. So that's one thing I really like. Another thing is their business model. So how that works is, so like I said, they compete against these games, for a tournament and whatnot. So this is the gross merchandise value. So then they divide the prize incentives, and what the company does, they collect a revenue based on a percentage, 14% take rate of the $1.20. What really impresses me is the gross margin is 95%. So pretty much because it's more like a platform business, so a lot of the expenses just more maintaining that platform. So the earnings are very high. So the gross profit is very high margin. So I really like it. And this is their longer term business model. So they're hoping to earn approximately 25% margin on the 16 cents over the longer term. So that's one of the things I really like, a high margin business. If they continue to grow this value, the more income or profit they will have. And one of the things I like was quite interestingly, I also was I think in the last video I was on this slide, I was talking about the valuation, how FEAC at that time was trading a significant discount up to their peer median based on these companies. So I took the average and kind of calculated what the expected price would be, and it was very interesting. I just checked it; it was about $19, well, which is really around what today is. So I have been started slowly taking profits. I took a little bit today. I do have some left. I'm not sure what I'll be doing with them. I'm probably gonna see how it behaves. If it continues to go up, I'm probably likely to trim back on some more. And if it goes, I don't know, double to $40, I'll probably sell out most of it. But I mean, if it merges and if it tanks, I may buy back some. So I haven't decided on that yet. But I really like this company. Another reason I really like this company is because of DraftKings. The management team that is bringing skills to the public. It had brought DraftKings to the public previously, and then DraftKings has done very well. So that's the kind of anticipation. And I really like this, their business model and what they're doing. So I really still do like FEAC. But it has gone up to where I kind of expected they would to be. So now I'm at a time where I'm not really sure what I'll be doing with it. Okay. Let's see. Hey Nee, hey Cindy, hey Vante. Hope you guys are doing well. Thanks for joining. Okay, so another company I want to talk about is C Limited. So again, I've talked about this company previously. I think they were trading a bit over $100, and at that time, I really liked the company, and I still do. I wanted to add to this position after their most recent earnings. Because they were kind of a little bit below general analyst expectations, so I kind of thought the stock would pull back. I think it was around here, and then they pulled back a little bit. I was thinking about adding, but before I knew it, it was started to climb. So I haven't added some C Limited yet, so I'm gonna just wait. I really still do like the company, I like what they're doing. Their most recent earnings report, they were growing, as you can see here, they were growing year-over-year growth of GAAP revenue of 99%. Which is incredible. Their entertainment commerce is, their year-over-year growth in digital entertainment bookings is over 110%. Their e-commerce business is growing at 173%, which is incredible. These are their two main businesses that they have. They have three businesses really. The other is their financial business. So digital entertainment, again, very good growth rates. Valuation is a bit expensive. I did a valuation comparison in that video, so if you had a chance, you could just go check that out. The digital financial service is a very small part of the business, but I do like it as well. And their gaming business, they are creating a new game, I believe, or will be, because they made this acquisition. I talked about that in my video. Really doing the right things. I still really like it. Planning to add to it when it does pull back, if any. Great business. The other one is Crowdstrike. So Crowdstrike also had a huge run up since I last talked about it. I think I was talking about it at the $100 level. It's now $178. It has run up a lot. There's great reasons for it that's happening. If you looked at their growth rates, they're growing like 80%, almost 80% expected current year 2021, which they're actually off year end. I think their January 31st is their year end. So great business, great growth. I really like their business and what they're doing. They must be doing something right to attract over 50% of Fortune 500 companies to use their service. And their most recent earnings was very incredible. They were able to, achieve $907 million in annual recurring revenue. This is annual recurring revenue, so it's income that they're continuously going to earn every year. One of the encouraging parts is they are expanding their platform and more modules. And then it says, continue strong module adoption as customers with 4 or more modules increase 61%. 5 or more modules increased 44%, and 6 or more modules increased 22%. So this is suggesting that they are able to not only grow their business by customers, but at the same time, each customer are going more using more of their modules to protect certain cybersecurity threats. So very great earnings report. I really like how they are able to increase the revenues by 86%. but also increasing the recurring revenue by 81%, which is great. Great gross margins at 77%, which is an improvement at 74% previous year. They are a net income or loss. They are a GAAP net income or loss. They are in a loss position, but non-GAAP is 8 cents per share, which is incredible. I think analysts had it at maybe break even, so that's a pretty big beat. Again, and looking at their cash flow from operations, 88 million. I think I covered cash flow in my last video. They are pretty good. So and they're very low debt. So a very strong balance sheet and a positive cash flow. So I really like this business. I will still continue to hold it. I'm not sure I would be buying around this price, but on any significant weakness, I would probably be buying some more shares of Crowdstrike. They are expensive trading. Maybe if we could take a look at it quickly. Let's look at it quickly, see what it's trading at right now. Okay. Estimates. Yeah, so like they're looking at price to sales of 35 next 12 months. Even the year after fiscal 22 and 2022, 31.4 times. So it is very expensive, but they are growing at, let's see what their expected growth rate is. So this year they're growing at 78%. Next year they're expected to grow 40%. I mean, it could be higher, I'm not sure, but based on what they're doing, they are definitely doing something right. And they are a cloud cybersecurity, not the old, you install your software and the low code, but they're on a cloud that keeps updating consistently. So I talked about that in my previous video, so make sure you check that out. I really like Crowdstrike, but getting a bit expensive, won't be adding at this price. So those are the few ones, just a brief update. I still really like all those three. Probably, I don't know which one to order, but I really like them. All right, let me see if there's any questions. Okay, no questions during live chat. If you guys have questions in the live chat, just message me in the live chat, and then I will answer it if in a bit when I have more, I guess, people joining. Thanks for joining. Let's see what else I have. Okay, so next thing I want to do is one that I'm looking at, and I may be adding it to it soon, is Longview Acquisition Corp that is planning to merge with Butterfly Networks. I talked about this in my previous live stream, which is last week. I almost added it today. I didn't get a chance, but I'll probably be starting a small position and just starting to build my position. I don't know how big this position will be and whether I'll be holding it long term or not. It just really depends on how it trades and where the price is at. So this one I'm still waiting on. I'm close to buying it. I'm still doing my due diligence on this one. So perhaps maybe next week I will do a deep dive on this one. Maybe, we'll see. Okay, so the next thing I want to talk about is Nano-X. So I talked about Nano-X as a very disruptive company that provides X-ray sources, that creates a X-ray system that is very significantly less cost than the traditional X-ray source that they're using. Because they use a cold cathode, and the previous ones are traditional ones use a hot one. So the difference is really technical. I don't want to go over the details, but I highly encourage you, if you're interested in this company, look at their F1 filing. They have a lot of information about their technology, their business, what they're trying to do. A lot. This is like probably 200 pages or something. This is the prospectus. So each company, if they want to go public, they would have to file a prospectus that gets audited. Lots of great information, very technical. But if this is something you're interested in, I highly suggest you to look into it. Nano-X, last week I talked about they're going to do a live demonstration on December 3rd. That went through. It's published or is on the available for viewing on their website. So this is it. Right here, and it's good. It's great. I mean, they did a live demonstration. There were two people, two radiologists, kind of looking at the images that were taken. One is Dr. Michael Utes, which is also actually a kind of not really worried, but I would have preferred a more independent person because that person is actually on the board of Nano-X. But I mean, if you just look up his details, he has a lot of qualifications underneath behind him. So I do trust what he's saying, but I would have preferred an independent party. So the live demonstration went well. It went through. Unfortunately, I would have preferred to be in a bigger audience. Like it was just like them in their office.
I feel like
We see
yeah,
the
so just
joints,
these two
the
people were
cortex,
looking at the
bony
X-ray.
trabecula, small detail.
I'll leave that for you guys to watch. It's about 30 minutes. It's a good watch if you're interested in the company. Another thing I want to suggest you to watch if you're interested in this company. So a lot of the short sellers kind of talked about, you know, this is fake, this is not real, but there are actually quite a few leaders in this field, like from Duke University, from Stanford University in this video that talks about their technology. And I did some research on those individuals and kind of snooped them up and looked them up, looking at their background. So they're legitimate, appears to be. So they talk very positively about Nano-X technology. And then a part of the short report also talked about fake clients, fake distribution centers, etc. This video actually has some of the customers that were in that list that we looked at last week. Again, it's them talking about Nano-X and their technology. And I've also did searches on these people. They're legitimate individuals. For them to come out and say this, so it means a lot. And that's why I'm actually here today, is to kind of talk about those two short reports. I was very fortunate to find another report which was published just last week as well, and it's by Deep Knowledge Analytics. They seem to appear to be a third party. They kind of disclaimer here saying that they're in no way affiliated with Nano-X. They don't hold any shares. They're more of a company that kind of do a deep dive on analytics on certain trends like Bitcoin or fintech or health, aging. They do a lot of analysis. So if you even do a quick search on what is it called, Deep Knowledge Analytics. So they do a lot of different longevity, healthcare. Do a lot of different reports, and they actually did one for Nano-X and their technology, and looking at what Citron and Muddy Waters kind of said about in the report, and just kind of supposedly independently looking at whether their claims by the short reports were true. So very good. I'm just going to go over this, and then after this I will do some Q&A, but I really want to talk about this because I was very hopeful. Like the short reports actually made me a little bit nervous, but I stepped back and thought about it. A lot of the claims were very they say, okay, I'll go over this. It actually goes through some of my thoughts. So one of the things they said was that the Citron and Muddy Waters cell report kind of say, this is from the Citron research report, say, a better medical imaging device that is low cost, portable, and will forever change the way diagnostics are done globally. And this is a new innovative technology will soon replace the legacy of X-ray market. So I agree with what the report is saying. So then the report says, Nanox claimed to have greater, better. Oh yeah, so it's like this report says we were unable to find any sources demonstrating that Nano-X claimed to have created a better medical imaging device. So this is what they're saying. Nano-X is not creating a better medical image, but what they're doing is they're creating a novel X-ray source. So in an X-ray, there are like these bulbs, they call it light bulbs. Okay, these bulbs, and basically this is what Nano-X came up with. It's just a source that creates the X-rays is different from the traditional source. So this is a source that they've created that kind of develops the images. So it says in layman terms, Nanox built a digital X-ray source in the world of medical imaging that uses analog tubes. And these X-ray light bulbs, call it light bulb, is claimed by Nano-X to be an order of magnitude cheaper and more efficient, thus enabling the manufacturing of significantly lower cost imaging systems. Nanox's business model lies the ability to provide affordability and accessibility to medical imaging by increasing the number of devices in the world rather than replacing the legacy devices. So one of the claims that the short report say they're going to replace these legacy devices, no, that's not what Nano-X is trying to do. The short seller's reports factually misrepresented Nano-X device claims. The core business model by positioning Nano-X to be a device manufacturer competing against large and well-established medical device. So one of the short sellers says you cannot compete with Siemens or Philips and etc. But this is saying that that wasn't their goal. Rather than they are trying to, I think even later it says, what they're trying to do is create a new class of affordable medical imaging systems through this novel X-ray source. And on the contrary, they formally state their intent to license their X-ray source to the likes of GE, Siemens, Philips. So instead of competing with them, they actually don't mind licensing their X-ray source to these companies. So they're in a way that they're willing to work with these companies rather than replacing the legacy system. They want to create these X-rays for those that are in need and those that maybe perhaps can't afford. Again, affordability, accessibility to medical imaging by increasing the number of devices worldwide rather than replacing the legacy devices. Okay. What else? So that's one. Again, it just keeps saying, it's to replace the X-ray light bulbs within the existing systems, not replacing the whole system itself. We expect that the existing market participants will remain key players, meaning the GE, Siemens, Philips, etc. in the future, and we aim to form alliances with several of these leading market participants, including through licensing. Okay, so of anonymous and unverifiable expert witness. So a lot of the short report, the two short report kind of refers to these expert witness, but they only refer them to as radiologist A, B, C, D, E, and joined by a former employee. So they made a good point. The use of expert opinions is a valid approach to any exposed and analytical research reports. And when the professional opinions of such experts can be validated by professional credentials and reputation within their domain of expertise. So you gotta put a name to these radiologists, because then how do we know who is actually saying what, And like I talked about earlier, if you look at their website, they're backed by these, not backed, but they have these advisors that are like, head of radiology in the University of Stanford or whichever university. I don't remember the university, but if we look at even the advisors. Yeah, University of Washington School of Medicine, University of Arizona, Stanford University. These people are their advisors. So I find it kind of hard to believe that after so many doctors and so many intelligent individuals, reputable individuals that are in this field. So I do, I rely more of these people as opposed to the short seller. I mean, you gotta kind of also think about what's the reason for the short sellers, right? The short seller wants the stock to fall. That's how they make money. Short seller sells those shares right now and buy it back at a lower price. That's their goal. So be careful with these short reports. Challenge it, just like this report is doing. I do agree. I don't fully agree with everything in this report. I will talk about some of the other stuff later. So they're just saying that, once again, we have failed to find any sources indicating that Nano-X claimed that its imaging device, Nano-X, was capable of generating CT scans, as designed to function as housing mechanism for nanosource and not a device that aimed to compete with the legacy X-ray. So this is talked about earlier. So this is the misrepresentation of Nano-X clinical data, image status. So they're talking about Citron says Nano-X has never published any data showing their machine images compared to images from a standard CT scanner. Again, as alluded to above, the company's product is a single and more cost-effective, efficient component. It's a component intended for the use in existing medical imaging devices. As such, the company's device cannot show imaging data because it's not an imaging device in and of itself. Again, what they're doing is their technology is the X-ray source and not the device itself. That's what they're trying to say. And never in their F1 filing that they claim to operate or compete on device side, and are very consistent to demonstrate comparative measure between sources and not systems. Sources, not systems. Even in their F1 filing, they said the comparisons below show the X-ray images taken by our novel X-ray source, single tube. By the way, this is their FDA filing, a single tube or single source. They are filing are going to be filing a multi-source very soon. That was in their investor presentation just after the RSNA live demonstration. So it's expected to be used in Nano-X ARC and commercial alternative. Misrepresentation of industry facts. Oh yeah, so this is kind of them saying that comparing the 21 employees or how much they've spent, saying how little they're spending on research and development. They even said, don't want to say anything here. Yeah, let's skip that part. Yeah, so they just kind of say to a lot of negative things, how like they don't spend enough R&D and stuff like that. But they never say anything about, Nanox already has a research and manufacturing facility in the University of Tokyo in Japan. They never talked about their partnering with Foxconn Taiwan. I'll talk a little bit about Foxconn a little bit later. So they failed to mention these good things. They only mention like, they spend this much. And technically speaking, they were kind of wrong, maybe kind of right. But look, it says, Nanox claims that it has disrupted the medical imaging market with a total R&D spend of $7.5 million. This is actually only for 2018 and 2019 together. This does not include, I guess it's founding in 2018, but the technology was not started in 2018. The technology was brought up in the early 2000s. I'll talk a little bit about that later. So the report kind of says here, the company had a cumulative deficit of 48.6 million and 18 million for December 31st, 2019 and 2018. The report says these figures are a total of 58.6, so this is not right. They're saying that this plus this is their total Nanox cash deficit. That's not true, actually. It's actually, this is 2018 value of cumulative, and this is the 2019 cumulative. So this should be the number. And this is the total net loss, so not necessarily cash deficit, and not necessarily just the cash spent on R&D, because this includes general administrative expenses, etc. So again, don't always rely on reports. Kind of challenging and kind of think about it, whether it makes sense, and validate it with the F1 filing, which I did. They're saying our technology has its roots. So the technology actually started with Sony, that with other technology partners, and I forgot what year, but it's probably early 2000s. And then in 2009, having invested substantial resources in developing this technology for over a decade, including a joint venture called Field Missions Technologies Inc., Sony ceased development of the project. So this is after they spent 10 years in developing this project that they stopped using, because Sony wanted to develop this project for, I think, display images on their TV. But unfortunately, I think it was I'm not sure the reason, but they ceased to continue on with this technology. And then in 2009, FET dissolved and transferred certain assets to FET Japan, scientists on our team who worked on FETJ, which is applied their expertise to develop the non-display related applications, including our X-ray source technology. And in 2011, our predecessor company acquired certain non-display related know-how from FETJ, and certain members of the FETJ technical team joined us. So this technology has been developing for a long time, and not just purely that 7.5 million they're saying. They're saying even here that I can't really validate whether this is true, but they're saying that there's some information online that shows at least 600 million were invested in the display before Nano-X acquired it. This fact serves both a validate to a large portion of Citron's claims and to provide solid justification for Nano-X valuation. I don't think I kind of don't agree with this, because valuation shouldn't be on how much a company has spent in the past. It's really about in the future how much they can earn. Like if you spend, I don't know, like they said 700 million, but you created nothing, there's actually no value. But so I kind of disagree with this, not differently, but I do expect that this technology is real, and the valuation shouldn't be based on that. Maybe based on more of what I've done last week about what your potential earnings is in the future. Nano-X. So on the website we saw last week, Nano-X does not say, but they referred to World Health Organization that they say 2/3. They still say other thirds has to wait weeks and months. Somewhat true. It's on the website. So this is just kind of referring to where they got that from. This is actually from 2012, so this might be outdated. Fair enough. But like this report actually done research into United Kingdom, Canada, about how much delayed is people waiting for these imaging scans, images, digital images. So there does look like there's a need based on more recent information. Let's see. Okay, so this is the also this misrepresentation of the industry practice. So this relates to the FDA approval. Okay, so Citron report says, first, it should be noted that Nanox did not even submit a novel product. This is kind of true because it's not a novel product, it's a novel source. If you're saying you have nothing new, by submitting a 510K, you're saying that you have nothing new, and they're seeking easy approval as you're just another product that has already been tested. As stated previously, the Nanox core technology and innovation is not in the device, but in the novel digital X-ray source. The FDA main focus is about the impact of any medical technology on the actual patients. FDA regulations. So again, it says, as viewed by the FDA, the Nanox X-ray source is not a novel technology. Before I continue, I'm just going to see if there's any questions. Hey, Gavin. Okay. Let me just keep going with this company. I'm really excited about this company. I mean, if they are able to do what they're saying, it's going to change, change the way digital imaging is in the future. Even partnering with these the bigger companies. Nanox submission of the 510K is accurate in terms of the impact on the patient's exposure to radiation and their safety. Nanox X-rays are equivalent to the X-rays of other X-ray sources already approved by the FDA and other vendors. As such, the Nano-X X-ray source, whether used for the Nano-X ARC or by any other medical imaging system, represents an X-ray radiation that is not novel in any way. Again, this is more like a component of a device rather than the actual device itself. Use of misleading information and attempt to discredit company partners. Yes, right here. So in the Citron report or research and the Muddy Waters, they say these customer agreements are fake. That is, they're saying they're not real. Both reports. So this was from the research, and this is from Muddy Water. This is from Citron. Muddy Waters to the same thing or something similar. Yeah, Muddy Waters right here. Both short reports assume that in their statements that the distribution partners for Nanox are meant to be followed by legacy. So yeah, so they think that their Nanox are meant to follow legacy medical distributors practice, which again is a misrepresentation of Nanox business model as laid out in the prospectus and investment materials and discussed earlier. The company does not aim to deploy its technology in a traditional manner. Hospitals and primary medical centers are not Nano-X target market. Their target market is medical clinic chains that have no resources to buy medical imaging systems at all. So they're tailored more towards those that are in need that cannot afford. As such, Nanox seeks an entirely different type of partner capable of delivering the company's products into urgent care units, outpatient clinics, and the other thousand of medical service providers who lack the financial capability to purchase high-quality medical imaging in-house. None of the traditional distribution centers have real access to these locations simply because they don't sell there. Nanox has a unique business model that involves product deployment in a mass quantities within countries and therefore must tie itself distribution partners that have both the financial and political pull to get Nano-X's as a service provider into the region. So this is like the claim. This is what the Gold Vine International is. But here, one of the customers. These are correct photos of the front office from the right angle. Not center stage. More of okay. So one of the client or customer you could see here in the filing. Yeah, so one of them is Golden Vine International, Taiwan and Singapore. So I looked into this one. Again, I want to validate what they're saying is true. So what they're saying is more of the Liao family was directly, how to put this? So Vine, let's go back. So this company is owned or our CEO of this company is, where is it? It's Pip Liao, who is the daughter of this man, Liao Wanlun, who is a rich like a businessman in Taiwan who owns a founder and chairman of this company, which is one of the largest tungsten carbide producers in the world, with over 16 plants and 15 office branches. So that's this guy right here. And this guy right here is Terry, was it Terry or Terry Guo? Yeah, Terry Guo, which is the founder and legacy founder of Foxconn. So they have a tight relationship. So Foxconn is also the producer of the devices, and the daughter of this man is the CEO of Vine Golden International. So you see that there is a linkage between, or there's relationships between the group of people in a way that they're not just any random people like so-called. She works in a hotel industry that has a little parent direction connection with the family business of Nanox mentions. That's not true. Oh yeah, there is Pepi Liao. That's the daughter of Liao Wanlun. So, what is here? Oh yeah, so I was able to find her on LinkedIn here. And so this is the daughter, that's her right here. And this is the father, which is this same person. And this is the president of Israel. So yeah, the Liao family has as well as Mr. Guo, which is the Foxconn founder, have strong ties to Israel community and politics, as seen here from the photos on the right. So this is Prime Minister Benjamin Netanyahu, and this is Miss Pepi Liao, and this is the father. So there is, so to me, this is legitimate. I mean, this deal right here. I mean, I don't think it's so-called fake customers. So like the short reports are calling it. Yeah, and here's another one, just another example. Gold Rush. They said it's like, this location. That's not true. They did some research, and they found that this is their what do you call this? This is from the South African Companies and Intellectual Property Commission of the Gold Rush Trading Company, which is also on this list. I didn't really verify this, but I just kind of read through it. It looks legitimate. I searched up this guy. He seems legitimate. Like, well, I saw his LinkedIn profile, but I believed. I actually looked into this one. I searched up online, reading about both Pepe Liao and this person. What else? So. Oh yeah, Nanox Australian Distributors, for example, is one of the largest in the region with multiple health products lines, including medical devices. Again, these are pretty positive, and again, I didn't go through every single one of them, but I did validate some of them. Yeah. Also, I think the report kind of says, these contract may never materialize or go through. I mean, that's true. Because I mean, they have to have FDA approval first before they can actually distribute these or make these devices or X-ray imaging devices to be able to distribute them. They even said this on their report, on their investors report. Deliveries are conditional upon acceptance, test approval, and a local regulatory clearance in each region. So that, yeah, it's true, but that's the norm of how you distribute these devices that are yet to be approved by the FDA. But once FDA approval is passed, generally speaking, I think most countries are willing to accept it. That was also mentioned in the in the video with the I talked about earlier with the leaders on the homepage of Nano-X. Okay, maybe I'm going a little bit too long, so I'm gonna try to quickly wrap it up. It's not concrete, but it's... Oh yeah, one of the Muddy Waters report, Associated Riffman, who is like a previous prisoner, is involved with the IPO of Nano-X. I tried searching up that and I didn't find any information, and this report is saying the same thing. Like, there's no association between the gentleman and Nano-X at all. Yeah, so this is just basically what they're saying, like Muddy Waters, but there aren't, other than the fact that yes, this guy was a prisoner is true, but there wasn't any association with this gentleman and Nano-X at all. What else? Conclusion, as talked about earlier. And this is talking about the CEO having like not the short reports say the CEO is never even graduated or don't have the education, etc. But if you look at the background of the CEO, he's done a lot. Like, for example, where is it? Yeah, like he founded he was the founder and partner of WellSense, a medical device company that was invented a smart sheet technology to prevent pressure injuries in hospitals condition that claims the lives of 60,000 people in the U.S. alone each year. The company built this technology, passed FDA approval, is now successful in implementing their technology in hospitals across the U.S. I mean, the CEO has founded several successful companies, so you can't really say he's not. Yeah, he doesn't have medical experience, but his general background provides significant evidence his qualification to serve as CEO of Nano-X. Yeah, so generally speaking, like, yes, the short report has like made some good points, but they weren't really valid. I mean, I would trust this report over the short reports. I mean, I validated some of these information that were provided from the report. I continue to like Nano-X. Nano-X has gone up a lot recently, and then now, like I said last week, I was saying perhaps people are buying the rumors, selling the news. Like, you see this run up like 73% within the last month, and now it kind of came back down. So after the report, like I said, this may be like buy the rumor, sell the news. I wouldn't go in right away if you don't have a position. I would kind of look for stability. If you and make sure you manage your risk appropriately, because this is risky. I mean, if they aren't going to get through FDA approval, they're not going to sell anything. This could go back to go lower than what their IPO price would be. But so manage your risk properly. I wouldn't make it a big position. This is definitely speculative investment. So I will wait if you don't have any. If you want to get in a little bit, wait for stability, buy a little bit. Like I said, buy maybe 1/3 of what your position that you would want sometime soon, and then buy a little bit more after the FDA approval, and then maybe buy a little bit more after they start delivering the system. Okay, I know that was long, but I just wanted to bring, just kind of talk a little bit about the short report. Okay, let's see what's next. Okay, the other thing I want to do now is I want to do the deep dive into NGA. So that was requested by some people. I talked about it last week, but I was very quickly went through it. I didn't do a deep dive. So the next maybe 15-20 minutes, I'll be doing a deep dive in it. Okay. So this announcement was announced on November 30th that NGA, which is Northern Genius Acquisition Corp, will be merging with Lion Electric, which is a leading manufacturer of all-electric medium and heavy-duty urban vehicles. So the pro forma market capitalization is implied to be 1.9 billion. The transaction includes 200 million committed PIPE. They're planning to use the proceeds for planned expansion of the company's U.S. manufacturing capacity. So right now they only have a plant in Canada and Quebec. So they want to wrap up more, be able to produce more of their trucks and buses in the future. I'll go over that a little bit later. The founder of the Lion Electric is Mark Bedard. He is actually an ex partner at PwC, which is one of the big four. So a lot of good experience. Seems very educated, very smart guy. Let's see if I could find some information about him. I spelled his name wrong. 1 second. Bedard. Oh, I spelled Mark wrong. C, not K. Sorry. So that's him right here. He's been at Lion Bus for 12 years. Lion Electric. He's the founder. As you see, as a partner at PwC. I mean, to be a partner at a big four, it takes a lot of time and dedication and hard work and being smart too. So I think he's pretty qualified to lead a company. As the CEO. So we talked a little bit about the proceeds. So what's good about this company, they already have over 300 vehicles currently on the road with over 6 million miles driven. Lion offers 7 purpose-built electric truck and bus models. We'll go over that a little bit later. They expect to quickly ramp up to 650 trucks and bus deliveries planned for 2021. So we'll look at the projections a little bit later. Lion has identified 6,000 potential vehicles, approximately 2/3 trucks, 1/3 bus. The marketing plan is supported by over 300 purchase orders in hand and growing sales pipeline. So these information I'll talk about a little bit later in the investor presentation. The transaction is expected to occur and close in the first quarter of 2021. Okay, now let's look at the investor presentation. So introduction. CEO, I've talked a little bit, 20 years of experience in various senior executive positions, including as a partner at PwC. Founded Lion in 2008. Nicholas Brunette as EVP and and CFO. Has a lot of experience in IPOs, mergers and acquisitions, long-term track record in the tech and renewable energy. Ian Robertson, co-founder, served as CEO of Algonquin Power Utilities Corp. Until July 2020. It's a pretty big public company, and the pretty big company in Canada as well. Transaction details. So again, Lion Electric is the manufacturer and distributor of all electric, medium, and heavy-duty urban vehicles. Enterprise value 1.5 billion. We'll look at that a little bit later. 500 million of cash to pursue Lion's growth. We'll look at that. We'll talk a little bit about what the cash is used for a little bit later. So their plans to grow manufacturing capacity in the US, as I discussed earlier. Okay, so their mission, they're by 2024, again, this is vision and projection, may not get there, or they may knock out of the ballpark, who knows, we'll have to see. But they want 20,000 annual vehicle sales. They reduced their vehicle cost reduction by 50% and having an annual revenue of 3.5 billion. This is similar to what they've projected later when we look at the financials. They're targeting a 110 billion total addressable market in the North America. I don't know how true this number is, but they did provide some sources for that number. That seems a little bit high in my opinion, but again, they have 7 purpose-built vehicles of electric truck and bus models available to purchase today. This is interesting. So like I said earlier, they have a manufacturing facility near Montreal, Quebec, capable of producing 2,500 vehicles per year. So this is important. So if they want to produce what they want, suggested in the, I'll talk about this a little bit later, but if they want to produce more than the 2,500, they need a second plant or facility. So their strategy, multi-year purchase agreement for the purchase of up to 2,500 Line 6 and Line 8 trucks at a customer's discretion, executed in June 2020. So it seems like they already have a purchase order of 2,500 trucks already of the Line 6 and Line 8. So that's pretty good. They have visibility up to 6,000. I don't know what the visibility means, but I guess they expect to maybe see about 6,000 potential vehicle sales, including 300 purchase orders in hand and growing sales pipeline. So we'll see if these are real, whether these will be achieved in the future. Plans to develop a large-scale manufacturing facility in the U.S. And a state-of-the-art battery R&D and production plant. We'll talk about a little bit later. So they've got some pretty good industry partners, Dana, BMW, LG, etc. There's some strategic partners like Power Corporation of Canada, which is a pretty big company in Canada. It's like an investment. They have investment arm. They pretty much I don't know market cap, but let's see. POW is the ticker symbol. They have investment arm and an insurance arm. Like IGM Financial. Let's look at the market cap. $20 billion company. Okay, let's go back to the investor presentation. They have some select key customers: Amazon, CNR, Waste Connections, Transdev. Pretty big. I mean, if they could sell more to Amazon and more than 10, I mean, that'd be pretty good. But the first order is 10, expecting to deliver very soon. I think we're gonna hear some news about it, perhaps, maybe, about their delivery to Amazon, maybe, perhaps, I'm not sure. But that should be in the next couple of weeks, or I think I've read. So this is their timeline. So they started in 2008, so they've done, began manufacturing a proprietary chassis. They started with the bus. They get, working with some partners, LG. They implemented a proprietary battery management system. They got a good investment from Power Corporation, working with established suppliers for like BMW. And having in 2000, CNR replaces 50 truck orders. That's very positive. And And oh yeah, and they also had can't do this. So just recently, just yesterday, I believe, if I do Lion Electric news yesterday. Yeah, so they just signed an agreement just yesterday with ChargePoint. So that's pretty exciting to resell their chargers. So a leading blah, blah, have entered into reseller agreement with ChargePoint, one of the world's largest electric vehicle charging network. Under the agreement, Lion will offer ChargePoint's full line of commercial chargers and cloud services, further expanding Lion Energy's offerings of charging hardware and software solutions. So that's very positive. And I think that's perhaps maybe part of the reason why the stock went up, I think 10% or 8% yesterday. I forgot that number, but it went up good yesterday. Let's see, let's go back to the investor presentation. Purpose built for electric. So Lion built chassis, truck cabin, and bus body. Lion Advantage is supported by an R&D team of 100 engineers and technicians, so that's pretty positive. Manufacturing vehicles today, yeah, so that's very good. I like to invest in companies that are already producing vehicles instead of producing in 5 years or 3 years or 10 years or 7 years. I like to invest in a business that already are started to develop and delivery and starting earning revenue. So they have, so that's very positive. So again, they have about 400 employees. Again, they're close to Montreal, Quebec, the manufacturing facility, and to support the demand in the U.S. They're hoping to have more customer experience centers and R&D facilities in the U.S. In the future years, 2021. So here's the 7 products that they have that I mentioned. So 4 trucks and 3 buses, Class 6, Class 8. There's refrigerated Class 8, refuse Class 8. So this is probably what Waste Connection would use, which is Waste Connection is a waste management system truck, I guess waste management trucking business. So it's probably these ones. So they're in Class 8 already and Class 6, so which is pretty incredible. Again, some of the customers: Amazon, CNR, Molson Coors, Waste Management. So some pretty good big companies. The buses, again, some like Transdev. I don't know some of these, but they're delivering buses already. So this is in the pipeline. So this is the 7 above you saw, what they already have. They're anticipated to create 4 more in 2021 and another 4 in 2022 into different classes. Established network. Okay, so this is pretty good. So it's good to know that they already have a solid supply chain. Instead of having to source and find the right suppliers, they already have a fully supply chain spanning all required components. Alternate sourcing options for most suppliers, so that's pretty good. So if one doesn't have it, you can probably get it from someone else. 10 years of manufacturing experience have created a full supply chain spanning over 400 suppliers. So some of them are pretty good, big suppliers as well. Direct sales model. One of the things I liked is that they are helping customers select and deploy charging infrastructure. So they kind of help fleet operators. So they're ones that have multiple trucks in a specific place, so they could set up the charging stations there. They usually have the drivers go out and deliver or whatnot, and they come back and park and charge. So that's what Lion Electric is helping the customers do as well. They're working with ABB again. Now I already told you they are also working with ChargePoint now, or have a agreement in place. So the goal is to kind of help a smooth transition to EV, assisting EV infrastructure, delivering ongoing maintenance, and support customers' integration. So this is total addressable market, like we talked about, 110 billion earlier, and it seems like the goal is to have 15 states are set to have for 100% of medium heavy truck vehicles purchased to come to zero emissions vehicles. The Biden Clean Energy Plan is to accelerate transition of entire 500,000 school buses fleet to zero emissions vehicle. all new sales to be zero emission by 2030. So this is a huge catalyst for Lion Electric. So this one's kind of interesting, this long-term purchase agreement. So some customer agreed to purchase up to 2,500 Lion 6 and Lion 8 trucks at customer's discretion. So there are discussions and speculations that could be CNR, or which is Canadian National Railway, or Amazon. I don't think it could be Amazon, just because it says right here 3% already vested. So meaning, so out of this 2,500, I think, let me go to it after, sorry. Let me go through this first. So they're expected to deliver up to 500 trucks per year, 2021 to 2025, and 10% of my, so Lion has agreed to reserve some capacity to deliver these trucks to this customer. I don't know who it is. And also making sure that they would have 10% manufacturing capacity from 2026 to 2030. So it has to be a pretty big company. Lion committed to providing ongoing maintenance and training assistance. So on top of this deal, they also have equity warrant option. So as part of the agreement, Lion also issued a warrant to the customer. A warrant is kind of like having a right to take a stake in the company. Potential to obtain up to 20% ownership stake in Lion. That seems pretty high, but this is pre proposed transaction, so it's pre the merger. We'll get some numbers after. It works out to 6 or 7%, and later in the slides. So the full vesting requires spending at least 1.1 billion on Lion products. 3% already vested. So that's why I don't think it's Amazon, just because they just ordered 10. And maybe CNR because they have 50. So we'll have to see who it really is. So they already have agreement supply of up to 2,500 all-electric urban trucks already. So that's pretty good. To lock this up, they kind of have to give up some equity, it seems like. So this is their North America's largest truck fleet owner. So some of these are really, really big names. They call it the Lion 150, which is like a framework for identifying targeting truck fleets in North America. So the aggregate Lion 150 customer fleet of 700,000 of trucks. So they're looking to sell 20,000 vehicles, annually? One second. Yeah, annual vehicle sales. So to get there, it's about 2.8% of this. So, but I mean, I think it's doable, but I think there's a lot of, so it's just they currently engage with customer representing annual purchase of 40,000. So how much of this really would materialize or converts into actual orders? It's hard to see. But these are some big companies that are here, like UPS, FedEx, Nestle, Pepsi, Anheuser-Busch, DHL. If they work out one or two agreements, it could be really big for Lion Electric. Here's quite interesting, substantial reduction in vehicle cost by 2024. They want to decrease the cost of their vehicles by 50% in 4 years. I'd be interested to see how they're doing it. Mainly, I believe, is the reduction in the battery system cost, but I don't know how they're reducing these other costs. It's a big statement. But I also think the CEO is saying this because, I mean, he's pretty good with numbers, I assume, because he's a partner at a PwC firm, a previous partner. So I'd be interested to see how they're going to reduce the cost, but if they could, it would be very, very amazing. U.S. manufacturing capacity expansion, they're looking at this location as a possible contender. Basically, they want to make sure it's close to the largest portion of the TAM. They want a potential for municipal and state level funding, proximity to larger pool of suppliers. So this is timeline of when it'll be done. So they want a completion of the site selection Q4, ramp up facility ramp up, site staffing second half of 2021 or first half of 2022, and they need to start producing a production capacity first half of 2023. You'll see in the projections, end of 2022, I think it's 2,500 vehicles. So if they want to produce what they suggest, they have to move in this timeline. So again, they want to create their own battery. So they're hoping to assemble a battery system development and assembly facility project. So again, I think they're trying to work on the batteries so that in a way to save costs and eliminating supplier dependency. It'd be interesting to see if they could able to do that. Capturing additional value over entire electric vehicle cycle. So they kind of want to earn revenue throughout the cycle, not just selling you the car, but having data analytics, sustainable truck as a service, having all in one package, kind of financing solutions, energy, charging services, maintenance, optimization, etc. So they're trying to find different avenues to kind of earn revenue, which could be positive, which would be very positive. Okay, so here are the numbers. Transaction to the 200 million fully committed pipe. Closing value is 1.3 billion, 51 million of debt. Transaction expected completed Q1 2021. So the pro forma equity value is 2 billion. You strip out the cash and debt, it's about 1.5 billion. These values also don't, assuming warrants are not converted, so it's not adjusted for that. After the transaction, SPAC investors who are owning the NGA shares would have 20.5%. Lion shareholders have 68.1%. And here's, interestingly, they already have 1.2% from the customer, the multi-year purchase agreeing customer. So at the end of the day, if they are going to spend 1.1 billion, they are going to get about 7% stake in this entire business. So that's quite significant. So it'd be interesting to see who that is. So here's the proceeds, what they're the 500 million, what they're planning to use it on. So growth and expansion is about 300 million. Sorry. Advanced development of proprietary battery modules, as discussed earlier. They're building a highly automated battery pack assembly line. So they're spending about 130 million on the U.S. vehicle manufacturing capacity. 150 million are funding on R&D and innovation, and 50 million on general corporate purposes. Okay, here are some numbers. So this is the projection. So like I said, by the end of 2022, they could produce about 2,500. If they want to produce more than this, they have to have it ready in 2023 sometime. The U.S. facility, or else they cannot produce this. So I guess that U.S. facility is a lot bigger because they're more than doubling, more than producing. This is a tripling of 2022 total units sold or expected. So they need, I guess, it's a bigger U.S. plant. So here's the revenue. They currently already estimate 2020 about. This is 130. This is 0.5 million. This is for 27 buses. Oh, sorry. This is 29 million. So total revenue is 29 million. This is the trucking. Oh yeah, sorry. Here it is. So 0.5 million is from truck revenues. They already have 27 million for buses already. Total revenue is 29 million. Expected to go up to 204 million, which is a 608% increase in 2021, and going to 3.6 billion in 2024. So this is pretty aggressive. Be interesting to see if they could reach that. Very interestingly, that I'm quite interesting to see if they could achieve is positive EBITDA next year, 2021, positive EBITDA already, which is pretty incredible. Positive cash flow in 2023. EBITDA margin around, I think long term, like around 20% or 16.5% if you adjust for R&D expenses, which is good. I mean, they could achieve that. Again, projections are not, it doesn't always go according to plan, so just monitor it, see if they could achieve the numbers they've kind of set for themselves. So here's the enterprise value benchmarking compared to other companies. So Nikola, XL Fleet, Hyliion, Arrival, these are all SPACs in the same space for buses and trucks. These are just other EV SPACs. These two I've talked about on my channel, Fisker and Lordstown. So as of this time, the presentation, I think December 3rd, it's November 3rd, sorry, November 30th, I think. What was the date? Sorry, 1 second. The date was November 30th. So these numbers definitely have changed. I provided an update, so we'll go through that later. But you can see that initial, so the blue right here is their initial valuation, and this is the current valuation. Yeah. Current, announcement, and current. Announcement, current. So you see that they all kind of went up quite a lot based on the first valuation. This is the 2024 revenue, EV to 2024 revenue, EV to 2024 EBITDA. And this is the same thing, but 2022. And you'll see here that Lion Electric is more favorable because they already start delivering buses and trucks already. So that's why these numbers tend to be a lot better than the other ones that are perhaps further into the future. Okay, now let's look at the updated numbers. Okay, so these are the price, what they're trading at as of today closed. Hyliion $16 or Lion Electric or NGA to $16, Hyliion at 19, Nikola at 19 as well. FEAC, which is XL Fleet at 15, Arrival 36, Fisker 17, and Lordstown 20. Did I update all these numbers? Let me just check quickly. 16, let's ride. 1937. No, I did not finish updating these. Sorry, let me just quickly update these. 1937, Fisker, FSI. Fisker is 1729, 1721. Arrival, 3301. XPIC. Sorry, I was supposed to update that. 1572. Okay, yeah, so that's updated. So these must have been updated. Let me just check NGA one time. 1637. Yep, okay, so these have been updated. So these are the pro forma number of shares, or once they've already merged, these are their updated number of shares. This is their market cap. These are the expected sales from their present. So these are all SPACs, interestingly, and these are their expected 2021 to 2024 sales. And this is their price to sales ratio. So interestingly, Rival and Fisker don't have sales in 2021. They're not available. So let's look at from 2022 to 2024. Lordstown seems to be trading very interestingly. Fisker and Lordstown, although not exactly in the heavy truck and medium truck business, more of their vehicles. Their valuation is a lot cheaper than the other 5. So I think a better comparison is these 5 as opposed to with Fisker and Lordstown, which they are trading pretty close to each other. Although I like although I like Lordstown a little bit more because they're more closer to production as opposed to Fisker. Fisker is taking a little bit longer to source and get ready to produce their vehicle. But from the heavy and medium truck, you can see that price to sales of Lion Electric at current prices, even after they run up already, is trading very favorably compared to the rest, with a high of 2.25 price to sales 2024 sales of Nikola 2.25. And if NGA or Lion Electric trades at the same valuation at these companies, for example, like Hyliion, same valuation, NGA should trade at $23.87. Let me just remove those zeros. This is if it trades the same valuation as Hyliion, it would be at $24. If it trades the same valuation, it would be $36. This is saying how expensive Nikola still is after the rundown. So you can't imagine when they're trading at $90, right? And this is PIC. If it trades the same valuation as PICs, if it's the same valuation as Arrival or CIIC. When I look at these numbers, I think Lion should trade at least $20 if at a more reasonable valuation compared to the rest. I don't know if it'll. I think Lion Electric or NGA should hit $20 if these remain consistent. If these all continue to go up, the valuation all will continue to go up. But currently, Lion Electric is trading at a discount compared to Hyliion, Nikola, XL Fleet, and Arrival. I don't know if you call it significant. I would say pretty significant still, because the next one closest is $23. And how much upside is that? Let's say 23 minus this bracket. Wait, 13. Wait, sorry. Okay, equals bracket minus this divided by this. This is suggesting a 40% upwards just to get it $23. I mean, I don't know if I'll go to 23, but like even at trading still a discount at $20, it's still pretty good because you're looking at 20 minus. Sorry, my formula's not working. Let's see how much upside that is. It's 22% away from $20. I mean, I'm still holding it. I added some last week on the drop. I talked about Lion Electric previously. I like it. They're already producing the numbers. You know, if you believe in the numbers and the valuation of all these companies, it's still trading at a discount. I mean, just for that reason, I like it more than the others at this price. Probably won't be adding any right now. I mean, I'm happy with my position. So I probably keep my position in NGA or Lion Electric. I may sell depending on how much it goes up, or if it doesn't, I may buy. I would be a buyer if it falls back down to the 13s, 12, 13s. I may buy some more 14s, but I mean, it's one of my bigger SPACs now. Yeah, so I like it. Yeah, that's it for Lion Electric. Let me see if there's any questions. Hey M74796. Lion's symbol is NGA, so that's the blank check company that's about to merge with Lion Electric in 2021. I have it up here, NGA. So they're trading at a discount compared to the other companies. Yeah, even though like you're talking about 20 billion valuation on Arrival already. That's a pretty hype one. Like the stock price is already $33 and it was trading just $10 maybe about a month ago. So I mean, I think Lion Electric has some catching up to do. Although looking at the other companies, Arrival is still cheap compared to the other. I mean, it's similar to Hyliion, but it's definitely cheaper than XL Fleet and Nikola. Nikola is always like that expensive one. Yeah, I think that's it. I'll just see if there's any other questions. Anyone have any questions for me? I know that was a lot to go through, so I did a Nano-X stock update, and I did a NGA stock or Lion Electric deep dive, and I talked a little bit about Crowdstrike, C Limited, and Skills or FEAC, which is the SPAC. What else? Okay, I think that might be it for me. Let's see. Okay, so that was my second live show. I had a great time just doing. This is kind of my thought process when I actually like do the research myself. It depends on the company and the SPACs. I definitely look at the investor presentation. I do a little bit more digging, like looking at TAM and like growth rates and stuff like that. And Nano-X is a newer company, so there's not a lot of financials. So it's kind of like a binary outcome. It's either going to do very well, or people are going to lose their money. So it's really how convinced you are or how convicted you are on the technology. I did my some due diligence. I looked at some reports. I looked at their F1 filing. I understand their technology. Very technical, but I understand that they're trying to go for the X-ray source, not the actual device. Lots of good reputable people on their advisors board. You know, I read the short reports. They're questionable. I mean, again, like their purpose is to kind of draw back. Their purpose is to kind of hope that the stock price goes down, right? So they're a little bit biased in that way. I mean, in order to go public, they file these F1s and they're audited too. So it's hard to believe that after so many people looking at it, it'd be like all a lie. I'm not saying it can't be, but I like to, I guess, be more optimistic, especially this is I think a very a game-changing technology that could save lives, actually save lives, because the earlier detection from these X-ray imaging can really save a lot of people's lives. And that was said a few much times in those videos I talked about in the beginning. So those are the things I've been looking at. Thank you for joining me. Let's see if there's any questions. If not, I will head out. Okay. So thank you for joining me. If you have questions, please post them in this video in the comments below, and I will pick and choose some of them ones to look at and talk about it next week. Thank you so much for joining me. Until then, happy investing.